Rory, I'd love to know your opinion on the future of bridging finance and what's potentially in store for 2018 and beyond in your industry.
So Amy, if I can look into our crystal ball, it's really difficult to understand where are we going to be next year. There's so many other issues going on. Brexit, pick a subject matter, there are some issues. 10 years ago, we had the crash. There weren't that many bridging companies around. Things have changed a lot since then. The world is awash with cash, so there's no shortage of money.
No.
And so what investors are, they're looking at the different asset classes where they invest their money. So I expect rates to probably stay where they are. 10 years ago, rates were about 1.5% per month. Now they're roughly 1% per month. And if you start to look at an asset class, so let's just put some context in this. If you were to invest money in a German government bond, the return is negative. So let's be really clear. So what does that mean? So you have a large amount of money, you buy a German government bond, it costs you money to invest in Germany. You don't get a return, you actually pay more. If you were to invest in a Greek 10-year bond, those rates are 5.23%. A year ago, that 10-year Greek bond I think was about 7%. So there's less risk. So it's all about understanding the risk. So I think we'll see the same number of lenders around, there may be one or two more, because if they can get a better return than investing in a bond, so just to give you an idea, UK government bonds over 30 years paying 1.8%. Well, if they can lend money at 2, 3, 4, 5% and they understand the risk is low, that brings more money in, so I think we may have more bridging lenders. Yeah. Unless there are some massive changes, there's a war with North Korea, who knows, things might radically change.
Yeah.
You also need to factor in where are we in the property cycle. So there's a chap called Philip J. Anderson, he's worth listening to his research, and the property cycle normally runs for an 18-year period. And essentially what you have is there are 14 good years and 4 bad. You have the first tranche of about, it's approximate, about 8 years, then we get a little dip, and then it goes crazy again. Well, we are at the top of that first 8-year since the last crash. Maybe give it another year or so. Yeah. So in theory, if you look in London, prices have sort of, the wind's sort of knocked out of their sails. Yeah. So that would have an impact on risk for bridging lenders if people feel that it's too risky. Yeah. But then you only need to look around where we are today. In this area, there are lots and lots of flats being built, and there's an assumption that there's massive demand, so people will buy.
Yeah, and I think the demand, like you say, is still there. I know when I'm talking to agent colleagues and they're saying we're just getting so many applications, we need more properties, we need more properties. So I don't, even though we're at this a bit of a precarious time in property, we don't know where it's going to go, do we? Because as we say, the demand is still there and there's still lots of money in property too. Yes,
I think that's really the key thing, is it always comes back to land prices. The land prices are fair and it's profitable, but we're in a unique situation. We live on an island. It's quite difficult to create more homes with planning rules. So therefore, you have to look at the supply and demand. If there is more demand than there is supply, then there'll be demand for finance. Some of that finance will be development funding or bridging finance. And whilst there's more competition, rates will remain low. So I think it would look quite positive, but you have to understand all of the different markets that you operate in. One could be here in Manchester, or it could be very different in London, or different, say, for example, in Nottingham.
Absolutely.
But I think for customers, I think it's great, because competition can drive down price and make it a more advantageous.
Yeah, brilliant, thank you.